Hey y'all, it's Sandra Green, your girl, your go-to real estate agent here in Tennessee and in Mississippi. And today we're doing something different. We're not talking about relocating, we're not talking about buying homes or anything like that, but we're talking about something very special and something that's very important for those of you that own homes, those of you that are going to be selling your home, or those of you that are business professionals. So definitely stay tuned. I have one of my partners here in the business. As a real estate agent, we have attorneys, we got CPAs, we got tax preparers, and I have Kenneth Herron here with Herron and Associates. He is a enrolled agent, and today we're going to talk about different tax perks if you have a home, if you own a home, different reasons why it's important to own a home, and how you get these tax perks now. He's just going to also just tell you some new changes or whatnot when it comes to taxes. And then we're also going to talk about if you're a realtor and if you're a business owner, different things that you need to know as far as how you can, get different deductions and so on and so forth. But I am not a tax person. So that's why I've got Kenneth in the room today. So, Kenny, can you tell the folks a little bit about yourself?
Sure. First of all, my name is Kenneth Herron. I am a native Memphian. I'm a tax professional. As Sangreta's indicated, I'm an enrolled agent. Many of you, I'm sure, do not know what an enrolled agent is. So let me explain. An enrolled agent is a tax professional recognized by the IRS. The IRS grant us, enrolled agent, that status. We have the same status to represent taxpayers before the IRS as a tax attorney and a CPA. The only difference is we cannot represent you in court. However, we can be a witness for a tax attorney in court, but we cannot represent a client in court. I was with the IRS, 21 years, where I was clerk, start to bottom, tax examiner, manager, analyst, and eventually I left to start my own tax company. I've been in my own business now since 2004. I am knowledgeable in taxes, but as anyone who does taxes know, taxes are broad. If I don't know it, I know how to research and find the answer. Thank you.
Awesome, awesome. So thank you, Kenneth. Thank you. So Kenneth and I are just going to have a conversation, y'all. And I'm just definitely excited because y'all know that I'm not a transactional real estate agent. I'm not just going to sell you a house or help you buy a house or help you sell your house and just leave you. I'm going to provide you some valuable information, follow up with you, check in on you, and just be that person that's going to see you all the way through the life of your home and help your family members too. So here we go. We're just going to talk about some primary home deductions. So as a homeowner, when they're filing their taxes because they own a home now, Kenneth, like what are some of the deductions or some of the things that they can claim? I know like mortgage, interest, tax. Can you kind of help us understand what that's all about?
Yes. Well, prior to 2017, home ownership for tax purposes was very important. Prior to 2017, you could deduct your mortgage interest, you could deduct the property taxes, you could deduct if you ran a business out of your home, you could deduct part of that from as an expense. However, in 2017, when the current president was president, there was something called the Tax Act of 2017. The mortgage interest and property taxes were no longer as important as a deduction because they changed the standard deduction. And if you are aware of taxes, you know that there are the standard deduction and then there's itemized. Itemized deduction consists of mortgage interest, medical, property taxes, gambling losses, charitable deductions. All of that are part of itemized. Standard deduction is an amount, a set amount based on your status as single, married, filing joint, head of household. Your standard deduction was increased to minimize itemizing. So before 2017, let's say you were married, filing joint. then your standard deduction was roughly, I think it was like $15,000. All right. Well, mortgage interest for a lot of people and other deductions was more than $15,000. So you would take the itemized deduction versus the standard deduction.
Okay.
Well, after 2017, the government increased the standard deduction for married filing joint to $24,000.
Okay.
So that made your itemized deduction fall less than the standard. So you would take the standard deduction versus itemizing.
Okay.
And we're pretty much at the same level now. Not a whole lot changed in that regard. The IRS has increased the standard deduction. Okay. Which still, for most individuals, will alleviate them being able to file itemized.
Okay, so that's it. Go get into my next question. So I'm not a tax professional, and probably most of my viewers are not. So, like, what is and I see that when I used to do my own taxes, like, are you standard and itemized, and there's certain amounts as you discussed or whatnot. So, like, what is the drawback of them? Like, what's the difference with the itemized, and now that they've increased it, and now no longer you can itemize, like, what's the drawback?
Well, prior to 2017, the itemized portion of your taxes was an incentive to buy a home. Oh. Because you could itemize the interest and the property tax and all that. It was an incentive to buy a home.
Got it.
Well, the only incentive now is that you build equity in your home. Oh, chances are you can't deduct your mortgage interest anymore because it is less than the standard deduction. Right. So the only good thing is that you can build equity in your home now.
Got it. So let's go even deeper into that because I'm picking up what you're putting down, but I know, like, there's some people that's like they need a little bit. We need to go a little deeper. So because I still thought that was the same, but it's not. So with being able to claim these deductions, can you explain the way it used to be, how that would benefit a homeowner?
We use Schedule A for itemizing taxes. On the Schedule A, you have at the very top medical deduction, which in itself is very few people can take a medical deduction unless they've had severe medical problems that cause them to be hospitalized and all this kind of stuff. Because you only get a percentage of what you pay. You don't deduct the full amount. Right. All right. So then you come on and you got sales tax. Sales tax is there. Sales tax was started or given to taxpayers because an individual who didn't own a home automatically could not itemize because they didn't have enough deductions.
I didn't even know that.
Right. They didn't have enough. Right. So they pretty much was always going standard deduction. Okay. Well, when the government decided, okay, we're going to recognize these individuals by allowing them to deduct sales tax. All right. Okay. So that's the second part of the form. The third part of the form is property tax. Right. Now, there is a situation with property taxes. The 2017 law changed a lot of things.
And we're going to get into all of that.
It changed. The law was changed to minimize the amount based on the cost of the home of your taxes that you could claim, your property taxes. That law minimized. You couldn't go over a certain amount. Okay. Which, if you prior to 2017, the full amount was deductible. So there was no limit prior to 2017. Exactly. But now things have been limited and yes, pretty much. Same with mortgage interest. Okay. If your home is worth $750,000 or more, you cannot deduct the full amount of mortgage interest. There's a calculation you have to use to get to the amount, and you cannot deduct the full amount. Wow. But you used to be able to. Yes, and home ownership, home prices were higher on both coasts. You got your property taxes, then you got your in some states you're allowed to deduct vehicle tax. Okay. Tennessee is not one of them. Right. Mississippi is one. Right. All right. And then you come down and you got mortgage interest Prior to 2017, you could do mortgage interest insurance.
Okay.
They took that off.
Okay.
So, and then you come down, you got charitable contributions, and then down the bottom, you got so some of you people who love to go to the casino, you got gambling losses.
Wow. Did y'all know that? Gambling losses, you could claim that?
Yes.
And you still can or no longer?
You still can.
Oh, wow.
But you got to claim gambling winnings. And it cannot exceed the amount you won.
Wow.
So what all it did was limited the ability to itemize.
Got it.
And it sent more people to standard deduction because standard deduction was more than the itemizing on the Schedule A.
Right. So at the end of the day, all of this, what I'm understanding from it now, because there's no longer the itemized, it's just standard, then that big tax break or that you would have more money in your pocket, you would get a bigger tax return. They're not taking into account now because...
Well, the IRS really try to discourage tax refunds. Really, they really do. I worked there for so many years, so I still say we. But the IRS want to minimize refunds. They want you to come close to
breaking even.
Yes, as possible.
Breaking even.
Claim as much as you can.
So many deductions or whatnot on the front end, so that you just break even, and they don't owe the government doesn't owe you anything. And that's big business. That's government business. But no matter what your political beliefs are, no matter what your religious beliefs are, I'm just here to make sure that you are armed with the information to help you. Yes. And so that's what this conversation is about today.
Now, I'm not trying to discourage homeownership, at all,
right,
because homeownership is an asset.
Yes,
and you build equity in your home purchase. You don't build equity in rent.
No, you don't.
That's money gone.
Absolutely, y'all hear that, buyers, renters?
Yes,
absolutely. And that's one thing I was going to say too. That even though you don't get these perks anymore, as far as the deductions and so on and so forth, like you the tax breaks like you used to, you still are making money. This is your money. You get in this home, you paid $300,000, $400,000 on it. Now it has appreciated 2 years, 3 years later. Now you paid $300,000, but now it's worth $380,000. So that $80,000 difference, that's your money, And so you can pull it out and buy another property, or pull it out and get a new roof, get some updates. It's your money, and you can do whatever you want to do with it. So you still get that in home ownership. So thank you for that good note, Kenneth. So the new credits and deductions under the recent law, is there anything that we need to know under 25 and 26 laws?
As far as real estate is concerned, that's not a big change.
Okay.
However, there are changes in credits and deductions for the regular taxpayer. The child tax credit doesn't increase in the child's tax credit. And the child tax credit is a credit given to parents or guardians of children under the age of 17.
Okay.
All right. It can be used to reduce your taxes, and the amount that's not fully used to reduce your taxes is refunded to you.
Oh wow.
So and then there's also that's a credit that I like personally. Okay, let me say this. Years ago, you could deduct interest, credit card interest, and all of that.
Wow.
You could, years ago. They stopped. Well, the big bad bill.
The big beautiful bill?
Yes. It brought back a deduction of interest paid on new automobile.
Oh, y'all hear that? We're getting great knowledge today.
It's only for 3 years. It's between 25 and 28.
Wow.
If you bought a vehicle last year, it has to be new. It can't
brand
be
new.
used.
Brand
if
new.
You bought one in 2025.
Right.
Well, the interest that you paid on that loan is deductible on your taxes this year.
Wow.
You could, and another thing is, it's not used as a deduction against tax. It is a deduction that you can actually get refunded to you.
That's great. That's great.
So that's what I like.
That's awesome.
Yes.
So there is some good. There's a lot of changes that we really don't like, we don't care about, don't care for. But I just want to make sure that y'all are aware of these changes. But there are some other changes that are new and that are good. Yeah. So how about this one? Is there anything as far as seniors, the PMI, yes, as far as our seniors, and like what age bracket would that be considered?
Seniors 65 and older. Okay. Are now they are given a higher standard deduction. Okay. Because of their age. Okay. So that's going to help a lot of seniors.
So that's going to be, how would that benefit them?
Well, the standard deduction decreases your taxable income. Okay. Let's say your taxable income is $40,000. Got it. And the standard deduction is $22,000. Yeah. That means that now your taxable income is $18,000. Right. So it helps reduce. And that taxable
income, you're going to be taxed on.
Exactly. That's
absolutely.
That's correct.
So the difference with the seniors is going to be a lot less than the difference with someone young like me. So, yeah. All righty. So how about rental property taxes for those? Because I have a lot of clients that have a lot of rental properties, which is a great thing. You're building that generational wealth now. You not only have your own primary home, but now you've gone out and you've taken some of that equity or even all of it. And you said, you know what? I'm going to leave an inheritance. I'm going to go buy this duplex, or I'm going to go, partner with someone and get this apartment. So those that have rental properties, what tax breaks for them?
Well, rental property comes in two categories. You have the rental professional, and you have the rental individual who just bought a house and just want to rent it.
Yes.
All right. And those two categories decides what expenses you can deduct.
Okay.
Rental professional, let's say a company that all they do is rent properties.
Right.
They rent apartments and all that. I mean, everything that they spent, every dime they spent for the operation of that company to rent those properties is deductible.
Wow.
Every dime. An individual who has rental property, a house here, a house there, you can only deduct $3,000 of your expenses per year. Now if let's say you incurred let's say $13,000 of rental loss. All right, you can only deduct $3,000, but you can carry the $10,000 next year. There again, $3,000 of that.
Oh, so you can keep carrying it.
Right.
How long can you carry it?
Well, until you absorb it.
Oh.
But keep in mind, chances are each year you're going to have
more. Yeah.
And it's just going to keep going.
Right. So you'll never break even.
Yeah.
Wow. Well, that's good information to know. For those of you that just want to get a property management company, that's something for you to know. Now, let's talk about something that's really, really important, depreciation. And this form says bonus depreciation. So I know that in some instances, your property may depreciate based off of. Can you kind of go into the depreciation and different bonuses or perks with claiming, depreciation?
Depreciation is a way of you buy a home. Mm-hmm. The value may appreciate,
right?
But the home condition depreciates.
Yes, that's it. Exactly.
And so you're able to deduct the depreciation of the home. The bonus depreciation states that you can deduct the full amount one time only. However, I discourage that, and this is why I discourage it. If you deduct the full amount of the home the first year you buy it, you sell it 10 years later. You've got to go in and do what the IRS call recapture that depreciation.
When you off the sales price, off your proceeds,
it comes back on you now.
Oh, wow.
As a tax debt.
So you have to come pay that back.
Yes, that's why I don't. My clients, I tend not to encourage that, because if you're not going to keep that house forever,
Right.
the depreciation of a home is like 27 years.
Okay.
If you're not going to keep it for 27 years, if you sell it 10 years, 10 years, 15 years into it, then you've got those other 12
It's a
years.
Loss.
You got to bring back.
Right. So that's just depreciation, period. Not the bonus depreciation, but anytime you claim
That's regular depreciation. You are claiming the depreciation for the year that you filed that tax. That's regular.
Okay, but the bonus is the one.
You're claiming a depreciation for years out.
Oh wow. Well, now why would a person want to do that? Like,
tax deduction.
What would? Wow. So, like, who would that? When would you ever like? What would be a good reason for somebody to do that, and it would benefit them?
Well, let's say
period. Dot.
Well, let's say you had a good year profit wise, and you don't want to pay you don't want to pay taxes. So you get that bonus depreciation to decrease your taxable income. Okay, and then you're not looking in the future.
But this is your forever ever home, and you never gonna plan on losing. So then it would benefit you.
Yeah, it's a good thing.
So for somebody that it's their forever home, they built their forever home, their mansion.
No. Your forever home is a residential. We're speaking business.
Okay, so this depreciation
for rental property.
Okay.
Not for your ever home.
Oh, see, that's why we got a tax professional here.
Yes.
So this depreciation is for under rental property.
Right. You can't depreciate your personal residence. It's not a business.
Okay. So now we're going to talk about capital gains versus ordinary income, because I always thought capital gains is mainly with rental property. Is it with your own property as well? But it's mainly when you have multiple properties, then you can do the capital gains tax.
Capital gains.
Is that so?
It's
that's what I thought.
Not multiple. It can be a single property that you have, and you make a profit of it. That's capital gains.
But it would have to be a rental.
Yes.
Not your own permanent residence.
Exactly.
So I was right.
Well, hold on.
Okay.
That's not true.
Okay.
It can be for your own personal. If you're living in a home and you decide to sell it and you make a profit, that's capital gain.
Okay, so and then I know that now, is there a rule there too as well? If you've lived in it, you have to have lived in it so many years. And this is important to my military crowd, because sometimes we buy a home and we're not in it but for 2 years,
for the military,
or for a year and a half.
The military got carved out. They have carve outs in the tax system because of
that situation.
Yes,
okay.
But a regular person living in Memphis ain't going nowhere. They just all decide to sell their home. This is a situation with the sale of the home. First of all, your home should be worth more when you sell it than when you bought it.
That's right.
It should be.
It should be.
So the difference is called capital gains.
Right.
Now, there is an exemption for the capital gain up to $250,000. If your profit on the sale of your home is less than $250,000, personal residence,
real estate property,
personal,
your primary residence.
Yes, then you can exempt up to $250,000. It's not taxable.
Wow.
If you are a tax professional selling a piece of property, it's taxable.
Okay, so if I'm a property manager and I'm selling, or if I have multiple rental properties, not my permanent residence, and I'm going to sell this one and go buy, or sell this one to liquidate or whatnot, then I'm subject to this
capital gain.
Okay.
Yeah.
Got it. Now, is there also a rule or a time frame that if I sell this is my rental property, and so I'm going to sell it and liquidate in order to buy? Do I have like a certain time frame where
you have to be, if let's say you got a rental property.
Yes.
All right, and you want to sell it.
Yes.
In order to establish it back as a residential property, you have to have lived in it 2 years prior to the sale. If you haven't lived in it
No matter what,
you sell it, that's capital gains.
Okay.
But if you come back and live in it for the 2 years and you sell it, then you can take that exemption.
Okay.
The $250,000 exemption.
Okay, got it. Because I have a client that won a house. She won through some lottery that she did. And, she wants to sell it. But I know it's that time period. She was saying
2 years.
Yep. And she's like, just keep my information but she knew that, well, actually she didn't know. I had to go ask a tax professional for her. And I said, yep, it is. I think she thought it was longer. And I was like, no, it is 2 years. Yep. So yes. So if it's your permanent residence or where you live, then the rules are different but no matter what, if it's your rental property, you rent it, if you never lived in it, period, dot.
Capital gain.
You have to pay. But if you have lived in it for more than 2 years, or at least 2 years, a minimum 2 years, and it's your personal home, then you're good as far as on the capital gains tax. You don't have to pay. You're exempt.
Now, I find, and I'm not discrediting any other tax professional. I'm not going to do that. That's not what I'm here for.
Right.
But I find that in the sale of properties, the amount paid for the property is not deducted from the sale. If you buy a home for $250,000 and you sell it for $500,000, you pay $250,000 for the home.
Right.
That comes off the top.
Right.
The only thing you left with is the difference.
Right. Not the whole $500,000.
Exactly.
Just the $250,000. Absolutely.
Yeah.
And that you're taxed on that.
Then you start deducting your expenses to sell that home.
Y'all hear that? Because it does take. You may have to get a new roof.
Yeah.
You may have to get new flooring. You may have to get
paint the place.
All this stuff. So whatever, keep your receipts.
Yes, please.
Because whatever whatever it took for you to get your home and show ready so that you can put your best foot forward to get the most money for your home. Now, off of your profit, you can deduct those expenses. And now, so if it took, and that's another thing that we need to be educating our clients about, because I was at a house the other day showing, and the young lady said, well, my client couldn't afford to get new paint or get new appliances. They couldn't afford to. So they want to price it high. And now it's on the market longer. But if you go ahead and put your best foot forward, spend that money.
Yes.
Because you not only are you going to get, the best price for the house, but now you'll be able to deduct that.
Expenses. That's correct.
And then when you file your taxes, now you're more profitable.
Yes. That's true.
Wow, I'm learning so much. I hope y'all are. I'm sure you are. Because if I'm learning, I know y'all are learning. I'm so glad we're doing this. So you've already covered the other question that I had. So now, mortgage interest and standard deduction. I think we kind of talked about that too, didn't we? We just, man, Kenneth, you just spot on. You spot on. So this is saying something about passive activity loss rule. Does that apply here for a homeowner?
Passive, that determines. Remember when I said that you can only deduct $3,000 if you are if you're not
a property manager.
That's where the passive and non-passive come in.
Okay.
Non-passive is that business that's what they do.
Right.
And they can deduct all of the expenses.
ABC Property Management Company.
Yes.
They can deduct everything.
All the expenses. Passive is you.
Individual. I got 5 rental properties, and I'm a realtor or homes, and I'm managing them, and then
that's when you get the passive and non-passive.
Got it.
That's it.
Okay, so that's what that is, and these rules apply based on that.
Yes.
Okay, so now we're going to switch gears, and thanks for staying tuned, but definitely stay tuned for part 2, because we're going to talk about tax breaks and things that you want to know if you're a realtor or if you own your own business. We're going to shift gears. So, thanks for watching. Thanks for tuning in, and we're going to get ready to switch gears. So hang in there with us. Stay tuned.